Well, good morning and welcome to CBIA's 2022 Connecticut Tax Conference. My name is Eric Getty and I am the Vice President of Public Policy for CBIA. It's great to be with you all again, and there is much to talk about. Now, before we jump in, I want to take a moment and thank our program sponsor, PwC, for their support of this program. Now, just over a month ago, the 2022 legislative session concluded. There are always a lot of conversations about tax policy at the beginning of every legislative session, but this year, there were bipartisan calls for tax relief for both businesses and individuals that largely drowned out the usual calls for higher taxes. This conversation was obviously welcome news to those of us who advocate for the business community. Businesses still have much to be concerned about these days. CBIA's own polling shows that nearly 80% of our membership is still struggling to find and retain enough workers. Further, 65% believe that dealing with inflation and the cost of living is the most important issue in the coming elections, followed by 48% that think that state taxes and government spending is also an incredibly important issue. These business concerns are directly impacted by the state's tax policy. Lawmakers could have seized upon the opportunity to provide a once-in-a-generation policy changes that would have set the state up for a long-term economic growth by doing things like allowing pass-through entities to take advantage of the R&D tax credit, a proven revenue and job creator, or restoring the full pass-through entity tax credit for the state's smallest businesses. Unfortunately, some of these proposals fell by the wayside. Lawmakers did ultimately provide some of that relief, but as you will hear in a few short minutes, it is unfortunately largely temporary in nature. There was a lot of good that came out of the $24 billion budget tax and spending plan adjustment that was adopted with just a few days to go in the legislative session. Most importantly, despite calls for ignoring the bipartisan spending and revenue caps put in place in 2017, lawmakers ultimately respected these important fiscal safeguards. Further, about $3.5 billion from the rainy day fund will be used to help lower our state's long-term state employee pension obligations. Also, small manufacturers will now be able to take advantage of the manufacturing apprenticeship tax credit, leveling the playing field with their corporate competitors. An additional $40 million will be used of ARPA funds on top of the $155 million appropriated last year will be used to address the state's federal unemployment debt. Now, while we wish this number was higher, every dollar put into this fund will help avoid a 22% federal unemployment tax hike over the course of the next 4 years. We're grateful that so many policymakers on both sides of the aisle recognize that and resisted proposals that would have undermined our economic recovery. There are numerous reasons to be optimistic about the state's future based on the actions the legislature took over the last 3 months or 3+ months in the broad range of favorable economic news that is shifting the wind to our backs. We still have challenges ahead, but smarter fiscal policy and state tax hike avoidance has made people start to think again about Connecticut as a place to grow their businesses. So thank you all again for joining us today. We have a great program for you. Later on this morning, you're going to hear from Pullman and Comley's Greg Servodidio and the Connecticut Conference of Municipalities' own Randy Collins, who will provide guidance on ways to avoid pitfalls when it comes to your property taxes. However, first up today, it is my pleasure to introduce Robert Ozmun and Anna Hoti from PwC, who will provide a full breakdown of all the tax policy changes that came out of the session. Robert and Anna, please take it away.
Thank you. Hi, I'm Rob Ozmun. I'm a state and local tax partner based out of the Boston office. I have been in Boston for 9 years now. And in addition to covering Boston, I am down in the Connecticut, Hartford area a lot for my clients down there. Happy to be with you today. Anna?
Hi, I'm Anna Hoti. I'm a managing director in the state and local tax practice based in Stamford, Connecticut.
Excellent. So we thought we'd cover today primarily Connecticut. We're going to start there. But in addition, because of the region, we tend to think about the Northeast and the New York Metro or New York area. We also give some highlights around Massachusetts and New York as well to round out the hour that we're with you this morning. So with that, why don't we go ahead and get started with some of the developments in Connecticut. So House Bill 5473 was signed by the governor on May 27, 2022. And that has a number of provisions in it, both from the corporate standpoint and the individual standpoint. And the individual items aren't really listed here, but I'll cover those as well. When you look at it, one of the impacts of 5473 is to limit the amount of interest in tax refunds to $5 million. That one isn't that big a deal probably for most taxpayers. The second one can be, though, in that it prohibits a taxpayer from filing a tax refund 6 months after an audit. So typically, you're able to file a refund claim up until the statute of limitation expires. So if you're audited early on in your statute, or if you have extended it, you'd have time in which to react and file a refund claim even after an audit closed. Under this new bill, you're going to be limited to 6 months after the audit in which to file a claim. So it will be up to taxpayers to, if there's a position or filing that they need to make, to do so, within 6 months of closing of the audit. In addition, the bill allows people to also be audited or reassessed for sales and use tax purposes on multiple assessments. From an individual standpoint, they made a number of other adjustments, and that they expanded the penalty for failure to pay personal income tax withholding. They set a 5-year limitation period for amended returns for individuals seeking refunds for taxes paid in another jurisdiction, if the assessment is from failure to file a return in that jurisdiction. And it codified allowing S corporations and partnerships to file composite income tax returns as well. And it's that second comment that I made around the refund claims that people should think about, especially if they're even in the S corp or partnership realm as well, in that a lot of times people don't file in jurisdictions, and it may be 5-10 years down the road when the jurisdiction, say for example, Georgia, comes in and says, hey, wait, you should have been filing a return. They file the return, they pay the tax to Georgia, they go back a number of years, and then they come back to their home state and say, hey, I'd like credit for the taxes paid. And even if the statute's closed, a lot of times the states, a number of states will give refunds because, it's a change in liability for that additional credit. What this provision is actually saying is that, look, within 5 years, if you get a knock on the door and it's because of your failure to file, you're not going to get a Connecticut refund for it. So it is going to make people be more proactive, or should, about their filing obligations. Moving on, also passed was House Bill 5506, and that got signed May 7th, 2022. Some key pieces here that got enacted was it extended the excise tax on gasoline to November. It provides a $250 per tax credit for lower and middle income family. It raised the earned income credit to 41.5% of the federal credit. It increased the personal property tax credit to $300 from $200 for primary residence and motor vehicles. It caps the motor vehicle mill rate. And the biggest impact is that it's actually offering a new jobs tax credit rebate for people who are employing people in Connecticut. So if you create and maintain at least 25 new full-time equivalent jobs within targeted industries in Connecticut, you can qualify for a credit that's tied to the income tax withholding that those individuals would pay. Now, the credit, it requires you to put in an application and have the department agree that this is something that you qualify for. The industries that it's available for is very wide. It includes finance, insurance, manufacturing, technology, digital media, or any similar industry approved by the Connecticut Department of Economic and Community Development. The credit can be applied to corporate income tax, pass-through entity taxes, and insurance premium taxes. It can go up to 7 years, beginning 24 months after the approval. And uniquely for this credit, it is not subject to the Connecticut cap that's been in play for most taxpayers for other credits such as R&D. When looking at what qualifies, right, it doesn't qualify if you have employees that are added due to a merger and acquisition. Individuals that are transferred from a corporate affiliate to another corporate affiliate also don't qualify. Or if you're replacing full-time equivalents, those don't qualify. But in general, what you're looking for is a qualified full-time equivalent that has 85% of the median household income in the location where the full-time equivalent will be, or 37.5 for income. In addition, if you don't meet those qualifications, other certain qualifications, a lot like you see with like WOTC credits can qualify, such as veterans and other individuals that they're looking to incentivize you to hire. In evaluating qualified businesses, the DECD will determine, can you reasonably meet the full-time hiring requirement? Does the proposed job growth benefit a net economic development of the community and the state? And its proposed job growth will exceed the number of jobs, the businesses that existed before January 1st, 2020. When looking at the amount of credit you can get, it's really, again, tied to the full-time equivalence withholding. It's subject to 50% if you're in an opportunity or distressed municipality, or 25% for other locations. Last but not least, the maximum credit that you can get is $5,000 for each new and full-time equivalent. And it's capped at a $40 million cost overall for the state. So it's, again, a new development by the state in order to incentivize job creation, especially in this environment of where people are looking to add employees and having a hard time finding it. This may, allow you to look for, other individuals, incentivize you to hire them as well. Moving to the next slide, Anna. In addition to 5506, they passed 5505. This is tied to certain benefits for aerospace manufacturing projects. It allows the Department of Economic and Community Development to enter into assistance agreements with eligible manufacturing companies, permits a maximum total benefit of $50 million for one project, or $75 million for another, or for two, sorry. Provides benefits that may be utilized up until 2032. And it's really tied to sales and use tax liabilities first. So to the extent it's to incentivize you to put capital into the, into the economy and to invest in that and put that capital in place. But if you don't have enough sales and use tax liabilities to be offset, you can claim it against the corporate business income tax. And last but not least, if you don't meet the requirements of the program, it's subject to recapture. With that, Anna, I'm going to turn it over to you.
Okay, to touch first on a few miscellaneous enactments here. We have, under our Clean Air Act, a part of it to incentivize clean air is creating a property tax exemption for certain electric vehicles and charging stations. We had an excise tax and sales tax holiday for, gas, clothing, and footwear. The clothing one is passed, but the excise tax on gas, we have a few more weeks going until June 30th. Some adjustments to property tax assessments to incentivize expanding property tax exemptions for veterans. We have a recomputation of kind of their income to maximize their property tax exemptions, as well as, making it more mobile so that if they transfer within the state, they can kind of, take their property tax, exemptions with them when they move and continue to benefit from that. In addition to other procedural requirements requiring assessors to notify taxpayers if certain, exemptions are denied. And then processes around property tax exemptions for charitable use properties. Similarly, kind of trying to clean up, the process, a form for applying for an exemption for charitable use property, for making determinations and getting feedback on those determinations and stating the rationale if it's denied. And under the estate tax, there is an update, to conform Connecticut to the federal basic exclusion amount for estate and gift taxes, thus now conforming Connecticut to the higher federal exclusion threshold of about 12 million. Some administrative updates. We had a ruling in January of 2022 addressing the ability to utilize NOLs when we had an intragroup reorganization. And, historically, Connecticut has had limitations on the ability to use NOLs when you have, a merger of an entity. Connecticut doesn't fully, conform to 381, but rather they follow a lips and shops type of approach where, the business needs to continue so that when you have, a merged entity, you need to be able to show that those NOLs are being applied against, the income that originally generated those NOLs. So I think this is the first, ruling that, kind of applies that in a unitary group context. So in this ruling, we had 4 entities in a parent-sub relationship that filed on a unitary basis. 2 of those entities merged out, And, when they merged out, the surviving entity was allowed to continue using those NOLs under the theory that it's consistent with that rule because they were filing unitary before, the same income is being used to allow the offset of those NOLs, against that same income. So they distinguished it from, kind of the separate company return context where it would not be allowed if you could not show that those NOLs were offsetting, the same income of the business that was generated. In another information release, the DOR, issued some guidance clarifying the research and development corporate income tax credit. A lot of this is kind of an overall refresher of, relevant definitions, conforming R&D expenses to 174, the computation of 20% of the excess over prior year R&D expenses, and then updating the amount of the utilization. Generally there's a 50% limit on the use of credits, 50% of the tax. For R&D credits, you can use 60% in 2022 or 70% in 2023 forward. And then again, just clarifying, the process, the detail needed on the Form 1120 RC when you're, claiming the credit. And, if you're a qualified small business, clarifying that you can claim a refund if your income is zero and you have just a capital tax of $250, you can claim the refund. And that includes if you're part of a unitary group, if your share of the income or capital base is zero or just the $250 minimum as a small business taxpayer, you can claim a refund. And lastly, a ruling on sales tax of learning plans. The issue was whether these online courses were subject to tax as, digital goods, because Connecticut generally subjects them as a digital good as a sale of tangible property. The court did a true object analysis, saying that in this case, the true object really wasn't the digital good itself. It wasn't purely, the information that was being provided, but the true object was really a non-taxable service. In addition to having access to, the information, there were things like live tutors and practice quizzes and sometimes even certification, in a certain area. Which led, the state to conclude that, it was that service element that was really the true object and not purely, the digital good or the electronic transmission itself. And then depending on the nature of the learning plan, they could be taxable under alternate means, like if it's computer or software training, for example. So it just kind of, emphasizes the importance of going through exactly what's being provided, a true object analysis, what, is it really the service? Is it really the data? In coming up with a position as to whether it's subject to sales tax or not.
Hey, Anna, before we move on to Massachusetts real quick, just the NOL is a good reminder, again, about Connecticut's unique approach with the Lipson shops. It's a court case that people refer to where you tend to look at the residual income of the entity that had created the NOL. Is that same income being able to offset? This NOL ruling that came out, again, really highlights that looking at the group as a whole, at least from a standpoint of like a merger within the group. Doesn't change the historic. If you buy somebody outside of the group and bring it in, right, that's a different issue. It's really about within the group and that you get to maintain it. Other states, that can even be a problem. On the R&D one to think about, not for Connecticut, but other states, a lot of people are evaluating the whole impact of 174 as part of TCJA, right? They made a provision in there effective in 2022 that's going to require the capitalization of 174 expenses federally. States conforming to that is really tied about how they tie to the code, right? With Connecticut being, a current conformity state, that it's going to be tied to that capitalization as well. Other states are fixed conformity. So even if there's a federal legislative fix, some states will still have that capitalization to deal with. So I just bring this up to kind of highlight the issue that, for the non-Connecticut states, it's something to think about. And last but not least, as you were talking about on the sales tax fees, you hit it right on the head. It's really important to dig into what you're actually selling, right? Because, it may seem like that's a digital good. It must be subject to tax. But when you look at the underlying transaction itself, and what the objective is, perhaps it's not. It can go the other way too. You may be thinking, oh, this is not going to be taxable. But when you look at the objective of it, that it's really a transfer of software or the components, it can be, even if it's in electronic form. And you'll see that in a court case we're going to talk about in Massachusetts here in a second. So those are just some things to highlight as we're thinking about Connecticut implications. So Mass, all right, so Mass is still working on its budget. Nothing's been passed yet, but a few things to highlight that came in the Senate budget as of May 2026. Personal income tax conformity. So if you're in the corporate world, you think, well, what's the big deal? Massachusetts corporately, we again, rolling conformity state to the code. That means that, when there's a federal change, the Massachusetts automatically initially adopts it unless they've decoupled from that provision by, they don't allow the deductions, like they don't follow the dividend received deductions in Massachusetts or other pieces, but generally Massachusetts will follow. But what's interesting for purposes of the personal income tax is Massachusetts is stuck in the code of 2005, right? So there are sections of the code that they've actually updated to be current conformity. Like they updated the code to be current conformity to when 965 happened, the repatriation as part of TCJA. But generally for personal income tax, right, it's the code of 2005. And that applies to partnerships as well, if the partnership is tied and owned, to individual partners versus corporate. If you're a corporate partner, that code is tied, again, current conformity. So it's very complex as to the rules. There's obviously been a ton of changes that have happened in Massachusetts and federally that, since 2005, and what you need to think about in that unwind. So they're looking to get to, a current code conformity for personal income tax. As part of that, they're also looking to do student loan forgiveness, and which is essentially to say that, if you don't have to pick it up for federal, you're not going to pick it up for Massachusetts purposes. And last but not least, it looks to decouple Massachusetts from the 199A deduction for pass-through entities. And the reason they need to do that is really relied to the first bullet point, right? If you're stuck in the code of 2005, 199A didn't exist then, so it doesn't apply. They don't have to worry about it. If they go to current conformity, then they're going to need to decouple from it. Otherwise, you might get a benefit they don't otherwise want you to have. But again, Massachusetts legislative process is still in process. So nothing has happened yet, just something for us to be aware of. If we move on, so since we don't have a lot of legislative developments, we do have some judicial and administrative developments to talk about. And this one's a very big one, and one that's near and dear to my heart. And so when you look at this one, it's around whether or not Akamai Technology qualified as a software provider. And as a software provider, would it qualify as a mass manufacturer? So you may recall that in Massachusetts, that if you qualify as a manufacturer, you can get certain benefits, and you have to calculate your corporate income or corporate excise tax a certain way. And that's broken into two pieces. The first is if you're a Section 38 manufacturer in Massachusetts, that means that you are a manufacturer overall. Doesn't mean that you have to do it in Massachusetts. It just means within the United States, you're involved in a transaction or transactions enough where you're deemed to be a manufacturer based upon those provisions. And it's generally driven by a ratio of sales or property payroll tied to that manufacturing process. So the easiest one to meet is if 25% of your products that you're selling are manufactured products, you're a Section 38 manufacturer. The next test is you can qualify if you file for mass manufacturing status. And that's an application that has to be filed with the Department of Revenue by January of any given year. And that says that you're doing that same manufacturing activity, but you do it in Massachusetts. And it doesn't change the corporate income or excise tax benefit. What it provides is additional benefits related to property tax, local property tax abatements, and sales and use tax exemptions. So again, if you're in Massachusetts and you're a manufacturer, right, and you're doing it primarily in Massachusetts, you may want to consider filing what's known as the 355Q by January of a given year. And if you qualify, you can get sales tax and property tax benefits. And that is what Akamai did. Akamai looked at its activities, and in 2006, Massachusetts had said that software development was a manufacturing process. And therefore, in looking at it, Akamai said, hey, we're going to file a 355Q because we think we're doing it, and we're doing it here in Massachusetts. And we're going to try to get this benefit of not only the sales and use and property tax abatement, but that would mean if we qualify for that, we also qualify for the Section 38 on the corporate income tax. And they initially actually received approval by the department that yes, you're a manufacturer. But then the city of Cambridge, having the property tax reductions impact them, came back and asked the department to appeal it because they didn't think they were a manufacturer, because they didn't think they actually sold the software. They thought they were providing a service. And so the Department of Revenue and the city of Cambridge challenged Akamai on this case and said, you're not a software provider, you are a service provider, because the customers don't actually get the software, right? But what the board did is they analyzed the activity that was happening with Akamai. And they said that when you look at that activity, right, they actually are selling software and the customer can interact with the software. Just because they didn't deliver the software to the customer didn't mean that the customer wasn't getting software delivered, and the customer thought they were getting software delivered. The department, as part of its process in the court case, said that, well, if they're a software seller, why didn't they collect sales tax? They didn't collect sales tax. That must be an indication that they're not selling software. And the board said, that's not relevant for this analysis. The relevant analysis around sales tax was, would it be subject to sales tax? And the answer was yes, it would be, right? But what the board ruled was, because of the uncertainty, it made perfect sense that they didn't actually start collecting it at the time, because you can see the department challenged that they weren't doing software. So why would they collect it if there was an uncertainty? So that didn't prevent them from claiming the benefit of this. What it does highlight is, if you claim the benefit, they may actually come back and say they want their payment on sales tax related to it as well. And so you should definitely factor that in. So the punchline in this case is really around, evaluating what you're doing. If you're connected to software or other components that are in Massachusetts or in the United States, you want to evaluate whether or not you could be a manufacturer. And in particular, if you're based in Massachusetts with that activity, you want to evaluate that if you can get qualified for 355Q. And again, that due date is in January and can provide sales tax and property tax benefits. Last point is that this is being appealed. Crystal ball, I don't think that the appeal will be successful by the department, but the city of Cambridge has asked the department to appeal. So we'll have to wait to see if this is the final answer for Akamai, but it's a good decision as it stands today. One last comment. You guys will receive a PDF copy of this presentation. Anything in blue that you see in the presentation will link you either to the court case or our PwC Insight, where you can read more. Okay, Anna, let's flip to the next slide. So VAS Holdings and Investments LLC versus Commissioner. And this was really about whether or not income, capital gains could be subject to tax in Massachusetts. And the punchline here was that for non-resident shareholders, the answer was no. What's interesting about this case is, the court evaluated it from a standpoint of looking at the relationship between the S corporation and a partnership that was there doing business in Massachusetts, and whether or not they were unitary. And because it deemed them not to be unitary, the analysis in the case was they couldn't subject to tax at the individual, non-resident shareholder level. And this becomes very important because what you're seeing generally across the country is a melding of the business, non-business arguments and unitary in many court cases. And this just goes along those same lines that's happening. So as business organizations, as you're doing dispositions, you may want to evaluate the ability to do a non-business position, non-taxable position as it relates to the disposition. Just remember, as part of that analysis, you need to talk about the interconnection between the organizations and determine whether or not you have a unitary relationship, and if you've been treating it as such throughout the time that you've had those, that investment. And if you have not been treating it as unitary, and if you really view it disconnected between them, there may be an opportunity in which to allocate the sale of that disposition of that business and not have that gain subject to apportionable tax in the state. Go to the next slide. So the department's also issued a number of TIRs in the last couple of months, and we're going to highlight a few of them here. This one is tied to the Bay State gas case. And in the Bay State gas case, it was really about the deductibility of Indiana's utility receipts tax and whether or not the corporate excise tax that could be deducted in determining the tax on the corporate side. And what was ruled on in the case is that the tax wasn't on the business as a whole, right? It wasn't an income-based tax. It was just a tax the utility receipts. Therefore, they thought it was deductible. So as a result of that, the Mass DOR announced it would interpret the case very narrowly and issue a TIR to give guidance as to how to determine what is deductible. So to the extent that you pay things beyond income tax in the corporate realm, you may want to look at this TIR or insight to see what of those taxes could be deductible when determining your Mass corporate excise tax liability. Next slide. Two more TIRs to talk about briefly. The guidance is given, the department's given a bunch of guidance as it relates to pass-through entity taxes, right? It explains the election on the PTEs as enacted in fiscal year budget 22 and includes information around making the election, computing the excise tax, determining the eligibility to make the election, filing and paying the PTE excise, and claiming the personal income tax credit for qualified members. So if you're doing the pass-through entity tax in Massachusetts or even other states, I'll recommend, look for the guidance that the departments are giving you because it's very complicated. And as a highlight, in other jurisdictions, if you have like residents in Maine, there is a problem in certain jurisdictions about whether or not the taxes paid through PTEs will be creditable. So just as a kind of an inside baseball, Maine has a challenge issue with their credibility for their residents on PTEs, and that can impact your decision about whether or not you want to make them. But for purposes of Mass, look at TIR 22-6 and see the guidance by the department. And last but not least, in May, they've issued guidance as to relate to the Oracle USA case and what is how it should be treated for sales tax purposes. And the issue in Oracle was really around, what's taxable in Massachusetts for sales tax purposes as it relates to software. And the key about it is around the multiple state use application and determining that when you buy a license like Oracle that could apply to more jurisdictions than just Massachusetts, how do you tax that software in Massachusetts? Should it be on the full license, or is it on, the license, being used in the state, and then, from there, therefore only getting a piece? And what the court ruled in the Oracle decision is that it really should be allocable, right? Apportioned based upon the number of users in the state. What this TIR is doing is providing guidance to taxpayers on how to make that determination. And so with that, Anna, I think I'll turn it over to you.
Thanks, Rob. So to start with, New York had a couple of pieces of legislation relating to the pass-through entity tax. The first one amends the state's pass-through entity tax by creating a new S corporation categories for entities that has all resident shareholders. So what this does is it creates this election. You can either be an electing resident S corp, in which case the taxable income for pass-through entity tax purposes includes all the income of the resident shareholders, or an elective standard S corp election, which then includes just the income from New York sources. So this basically has the effect of expanding the benefit of SALT deductibility for residents, right? Where you have an S corp that has all resident shareholders. In addition, it clarifies that pass-through entity taxes are excluded from the definition of income taxes, to avoid, add back. Another item is that, there is a New York City pass-through entity tax effective in 2023. Partnerships with at least one resident partner or S corps with resident partners may elect, this New York City pass-through entity tax, which would be imposed at the highest personal income tax rate of 3.876%. And then there are, just some changes to the individual income tax rates. The second piece relating to this, given the timing of making these elections, is that New York extended the due date for making the pass-through entity tax elections. Companies now have until September 15th to make the election, but they do need to make estimated payments. So if you make the election by June 15th, you need to make sure your estimates are in 25% by June 15th or 50% by September 15th.
Hey, Anna, was there recent legislation that they were still working on in the last week related to New York City? And is that going to be talked about later and I'm just forgetting?
There was an economic nexus bill, which is pending. That's waiting to go to the governor. And And basically that would adopt an economic nexus standard, similar to New York State's economic nexus standard, where you have receipts in excess of 1 million for New York City corporate income tax purposes. That's what you were thinking of.
Maybe.
Then we have a draft reg following, kind of the MTC and recent California activity in this regard, addressing how internet activities impact Public Law 86-272. So I think similar to what we're seeing in California and MTC, there's a distinction, made between online activities that are limited to solicitation of sales of tangible property versus, online activities that are not so limited, and then, which would cause you to fail, or exceed Public Law 86-272 protection. So for example, unprotected activities, it's focused on online activity, like post-sale assistance. If you have, chat features that post-sale provide assistance, online, for example, websites inviting New York viewers to apply non-sales positions, placement of internet cookies and the purpose of the cookies, right? If it's broader than just soliciting sales, but if it's helping to identify, new products or remotely fixing or upgrading products, that all serves an independent business purpose from sales solicitation. Whereas, protected activities that are online, like if the purpose of the cookies is solely to gather consumer information ancillary to the solicitation of sales, you could still argue, that you're public law protected if that's, the sole purpose, of having that online presence. So it goes to, I think, another level of nexus analysis, which, we've started to think about in light of, MTC, California, et cetera, but it requires, more detailed understanding of a company's online presence before we can conclude as to whether, Public Law 86-272 positions would be a risk.
So let's pause here for a second, and just talk about this, because it has broad implications. So, and there's a little history here. This is why I like tax. Tax is really kind of a history. And so Michael Vitale, right, who works at the Massachusetts Department of Revenue, he and his, the Massachusetts Department of Revenue started working on cookie nexus for sales tax purposes, pre-Wayfair, right? That they thought that if you placed cookies on people's computers, that was like placing property in the state, and so should allow the state to then require you to collect tax and actually maybe even income tax. Then Wayfair happened, and the Supreme Court says physical presence isn't required anymore. Right? You can just simply, if you're availing yourself to the state and you have a certain level of transactions, and they used the one in South Dakota as like that was okay, didn't set the benchmark that that's what it had to be. They just said that was enough. You have nexus. Well, that case, while sales tax didn't limit it to sales tax, it really breaks down the door that physical presence isn't required. And so the only thing protecting you on the income tax is the federal law, Public Law 86-272 from the 50s. And that law is about selling widgets, right, into a state that are delivered from outside the state, right, where orders are approved outside the state. And the only thing that you do in said jurisdiction is solicit sales. So if you have people around soliciting sales, hey, would you like to buy our widget? And they say yes, and then you ship it from outside the state into the state, you're obviously then protected under 86-272. What the MTC has done, California then adopted in their rules, and that the New York is proposing to adopt, is said, well, this is a new age, right? And you're doing more than solicitation, but you're doing it from, electronic means. And we think that's enough to create nexus. So chat boxes, warranty help, things that you're doing from locations, maybe even call centers is not solicitation. And if you're providing that to customers in the state, they think that's enough to create nexus. Why does this matter? Especially to small, mid-sized Connecticut-based companies. Why would this matter? Well, go back to what I said about filing. Connecticut just changed their law and said that if you don't file a return within 5 years of your Connecticut return, you're barred a refund. Well, with these new nexus rules, if you don't start filing in those jurisdictions, and in year 6, they knock on the door and they say, hey, we think you had cookies in the state starting in 2022, and now it's 2030, you're going to actually end up paying the tax, or you could pay the tax in New York or California otherwise, and not have a credit in Connecticut. And this is going to be a wave. Like we saw with Wayfair and other things, states are going to jump onto this, especially states that are tied to the MTC, and start enacting it. the punchline question is, what's changed? Statutorily, nothing's changed, right? So what gives them the authority to change these regs? The only thing that they can really point to is, Wayfair. That Wayfair and that court ruling allows them to really knock down the door as to what creates nexus and really limit what the Public Law 86-272 provides. So I would recommend for the people on this call and others to evaluate your footprint and determine your nexus risk, not only because of the tax liability for the corporation, but the implications, especially for shareholders, on the ability to get credits and, in their home state if they have to pay in these jurisdictions at a later time.
Okay, a couple of other items here for tax years beginning on or after January 1st, 2021. For general corporation tax purposes and banking corporation tax purposes, taxpayers are required to add back the state pass-through entity tax that was deducted from federal taxable income. This needs to be paid in by June 15th. Otherwise, interest or penalties could apply. And then just an increase in New York to the economic nexus receipts threshold for state and MTA purposes from 1 million to 1.138 million beginning in 2022. Okay, we had Supreme Court reject the SALT cap lawsuit. New York was one of the parties. Basically the Supreme Court declined to review the second Supreme Court opinion that the tax TCJA's Act's $10,000 state and local tax deduction is constitutional, leaving it, I guess, to Congress to have to address, as the Supreme Court won't be addressing it.
Well, what's interesting about this, Anna, for us to think about is the political ramifications. So the states like New York, Connecticut, and others were challenging New Jersey, were challenging the SALT cap and saying that it was really unconstitutional for that to be part of TCJA. The failure for them to get that kind of thrown out puts pressure on what they're trying to do today with tax legislation, right? Those states want the cap to be, at least loosened up or repealed. I think it's scheduled to be repealed as it currently sits today in like 2026 or 2027. That obviously has lots of implications for all the pass-through entity taxes that have been passed over the course of the last 2 or 3 years. And so this is all interrelated to the politics of what's happening, especially as we go into the 2022, 2024 question, and beyond. So, again, this is why tax is interesting, especially for me. It's the politics of it, the history of it. It's more than just dealing with tax law. And there is clearly a lot of politics as it relates to the SALT cap and its implication to, certain jurisdictions.
We have a New York Division Tax Appeals ruling, Genzyme Corp. From April. And this addressed, it was a prior ruling, for tax years prior to 2013, New York provided that taxpayers could exclude royalty income received from related members unless, the payments were required to be added back. And then, there was a lot of back and forth in terms of what that meant, right? This requirement to be added back, taxpayers were taking the position that that language did not mean that the payor had to be a taxpayer or have nexus with New York. In this case, the New York Division of Tax Appeals, consistent with some other rulings in this regard, held that the foreign royalties could not be excluded from the entire net income because the related foreign entities were not New York taxpayers. So basically holding that requirement to be added back language implied that nexus was required, that it had to be a New York taxpayer in order for that to apply. And that, this was constitutional, didn't violate any commerce due process or equal protection clauses, and that, they couldn't be deducted from federal taxable income, but, you get some dilution by including them in the denominator of the receipts factor. So. TD Ameritrade addressed market sourcing rules with respect to payments made to a broker dealer. You have, the overall rule requiring sourcing to the customer location, right? And in this context, the question comes up as to who is the customer, right? So in this case, you know, the banks were making payments to the broker dealer, and the state was looking to the ultimate customers rather than the broker dealer to assert that, you know, some of these fees should have been sourced to New York based on the client locations. And again, this is where, you know, sometimes when you look at the sourcing rules, you know, looking at the contracts and who actually is making the payments, who is your customer is critical. And that really was the case here. The court held that, you know, the ultimate clients were not the customer. They weren't the ones making the payments to TD Ameritrade. It was the banks, and the banks that were located, you know, outside of New York. They held that there was no basis to conclude that any of this should have been sourced to New York based on the client location, because that's not where the customer was that was making the payments.
And that's a big issue in all states that have gone market. If you look at the course of the last 10 to 15 years, more and more states have gone from like a cost and performance approach to a market approach. It's not really applicable for TD Ameritrade because they've always kind of been market as it relates to kind of banks or brokers. But generally speaking, core industries, you know, widget makers, as I call them, you know, they who provide services, that market push has changed. And you've seen that in Connecticut, you've seen it in Massachusetts, you've seen it in New York, although they still can't seem to get the regs out. And so the push on this, it's really evaluating, you know, what that means to be market. And I want to point you back to California if you're in this industry of services, because they just recently changed their position on what is defined as market. Happened in like March. They pulled a couple of old rulings that they had out there that gave guidance, and that pivot in California, just like we saw with 86-272, will push other states probably to reevaluate how they've defined their market and really get people to start pushing towards more of the end user of the service. Instead of like looking at your customer, they may really start to push through to like where the end user is getting the benefit. And it especially makes sense in California, given their 12% population. They want everything if they can to get to a population approach, because a 12% apportionment is not so bad if you're the state of California.
Yeah, and I think we get that question all the time, even in Connecticut. I feel like Connecticut tends to lean towards a look-through approach. And I think cases like this just emphasize the fact that, you know, we shouldn't assume. We should evaluate our contracts, evaluate, you know, our relationships and who the customer actually is, and, you know, see if we can come up with a, you know, the best position.
And Connecticut doesn't have a ton of guidance out there, right? So, I mean, they've given some, but if you look at like a Massachusetts, I think I have referred to it before as like 68 pages of joy when you look at the regs on market-based sourcing that are out there, or California. And you can use those as guideposts, but they're not exactly applicable to Connecticut. There are differences in the words that they use and how they've applied it. So again, punchline is to evaluate your business, see what your positions are and can be around sourcing, because not every state will treat it the same. There's not consistency.
Okay, another couple of cases. In the first one, Bank Pullman, the New York court found that the taxpayer could not use New York City NOLs coming from 2008 to compute their PNOLs that were used in 2015 through 2017. You know, the taxpayer asserted that really New York City and New York state law should be the same in this regard, and that the look back period for purposes of computing the PNOLs should have gone back, you know, pre-2008. You know, I think the look back period for New York State was as far as 2001. But for New York City, for bank tax purposes, you know, the look back period didn't start until 2009. And, you know, it was sustained that New York City had the right to have a different look back period than New York State. They have their own provisions, you know, so they were not allowed to utilize those pre-2009 NOLs in computing their PNOLs for 2015 through 2017. So just a reminder to look for these New York City differences, as we sometimes assume that they should follow New York State. And I think last one for New York State is that, and this is a little bit different than, you know, different result than what we were talking about in Massachusetts under Voss Holdings, right? And a little bit of a tricky issue. Capital gain on the sale of an LLC interest was held to be subject to the New York City general corporation tax. So I think distinguishable from, you know, the conclusion in Massachusetts, this holding company that did business through an LLC that was doing business in New York City. It didn't have nexus itself with its own operations. It was not unitary. And nevertheless, the capital gain on the sale of this interest was held to be subject to the New York City general corporation tax. The taxpayer had nexus through the LLC's activities in New York City. And, it was determined that a unitary relationship was not required, in order for that to be includable in the base subject to tax.
And I think that's it.
That's everything.
So I don't know if anybody has any questions or we have a little extra time.
Yeah, certainly you want to encourage any of the folks viewing this to please put your questions into the Q&A function at the bottom of your screen. But Robert and Anna, if you wouldn't mind, I have at least one question for you. You covered Connecticut, Massachusetts, and New York. Of those states, or maybe even beyond that to the region, the Northeast region. In your opinion, what state is doing the most to encourage economic growth? And that could either be at the administrative level or at the legislative level.
I will give a standard state answer. It depends. All right. So it depends on your industry and what you're doing. So New York for a long time has really been trying to incentivize manufacturing, right? So if you're willing to be in New York and put $1 million of qualified property in the state, and it's depreciable, so that number changes. So you're going to need probably more than $1 million. But let's say you put $10 million of qualified property in the state. You can get a 0% tax rate for corporate income tax. You can't beat a 0% tax rate. That is a good number, right? And so, if I'm going to build a new plant, I want to look at New York to say what that means. Now, you'd also pick, when you're doing it, you need to evaluate wages, you need to evaluate property taxes. But from a corporate income tax standpoint, New York incentivizes people to put property in the state and do that. Massachusetts, if I'm a Massachusetts manufacturer, or even if I'm a manufacturer in Massachusetts, don't qualify for the state, but I do overall, putting property in the state, doesn't hurt me from the corporate excise tax perspective. Single sales factor, right? If I qualify. So that's an incentive. They have an R&D credit that can be helpful as well and help reduce it. And it's very effective at times. But what you're seeing on a countrywide basis is a drive to the bottom, right? You're seeing like North Carolina went single sales factor and is driving their corporate rate down to 0 by 2030. You've seen Indiana drive their rate down to 4.9, Arizona 4.9. Other states are doing a lot of incentives. So, the Northeast has a good, opportunity to invest in, and it's definitely improved from where it was, say, 10 years ago. But if you look at the other states, more around the country, those states are not standing still. So the real thing our businesses need to look at is really what do you need from a profile? Where does it make sense operationally? And once you understand the operational part, Eric, then you can evaluate, can I put it in the Northeast and how does that fit Connecticut? And last but not least, if you're evaluating more than one state, reach out to your advisor, whether it's PwC or others, to see where there may be opportunities where the state, you talk to the state and you may get extra incentives, much like this jobs tax credit that just came through, and how to get those. So it always pays to have the conversation before you make the decision, because once you've made the decision and you publicize, hey, I'm coming to your state, it's less likely you can get additional incentives.
Right. Anything to add on to that, Anna?
No, I think that makes a lot of sense. And I do think that's the key thing, because sometimes I feel like the state people are kind of last to the table, right? I think getting to the table up front, particularly to reach out to the state to negotiate incentives, that's where I think we can get a lot of bang for the buck if we can do that early on. So that's always, the first message in terms of trying to get additional incentives, for sure.
And it's not limited to corporate income tax. You may get a sales tax incentive. You can get property tax abatements. You can get job tax credits that can be applied to wages, like Georgia has a program like that. So there's lots of opportunities to have conversations about where you may be able to get a benefit if you're willing to invest. And it may be that it's not driven by income tax, it's driven by something else.
Yeah, and sometimes it's not incentives. Like I've done rulings where, like, okay, we didn't like this particular corporate tax sourcing rule. And, we kind of use we're not going to move into your state if we can't get to an alternate sourcing rule that's more favorable. And we got the ruling actually, like, because I think there was an interest, right, in getting the company to move into the state, and we did get the ruling that we wanted. And I'm not sure absent that we would have. So when you can think about it broadly like that, there's certainly, things that can happen, to get the benefit for doing so.
I'd say it in 2 words: be proactive, right?
Mhm.
And to be proactive, you have to get ahead of it before you make the decisions.
I think that's good advice for most things. One more question for you, and this is more Connecticut based. How significant is it in your minds that Connecticut will allow pass-through entity businesses to utilize tax credits, or specifically the manufacturing apprenticeship tax credit? Obviously low in terms of fiscal impact, but do you think that overall this is an important policy shift?
Oh yeah, absolutely. Because I mean, you want to incentivize people to live in your state, right? If I have this, I'm doing this credit. Because I'm required to do the pass-through entity, I want to at least give them the benefit of it. Otherwise, it's like giving an R&D credit but never letting them take it. So give them if you're going to give them the credit, give them the ability to use it at least with reasonable means. And if you're going to require people to do pass-through entity filings, why shouldn't it be creditable? It would be. It'd be a benefit you'd never get if you didn't do it. Actually, what you're targeting primarily pass-throughs. So it's a good program. It's the right thing to do.
That's great. And do you think is this a trend you think we'll be seeing in, or maybe other states are doing this already, but do you think additional credits or pass-through entities will be able to take advantage of additional credits in the future, sort of a leveling of the playing field, just based on the differences in how a company is organized?
Yes, I think what we're going to see is a continued evolution of the pass-through entity, and it's really going to be tied to what happens federally. So there's a cliff coming, as I mentioned, federally. I think it's in 26, where the SALT cap goes away. And some of these pass-through entity taxes that have been passed, where you make an election to do it, are tied to that cliff and they go away. So, and we also, as I mentioned, there are certain jurisdictions where the creditability of the pass-through entity tax is in question, like in Maine. So you're going to have all of these issues, and some of them are going to be gotchas that people are going to experience. And it will really be driven by those things and what happens federally, what changes. So, it's never constant. The only constant in tax is constant change. And so I would expect more change to come, which is why you guys need us, which is good for me, right? But at the end of the day, more change to come as we evaluate this. And just stay tuned. It's all going to be driven by what happens federally.
Anything additional, Anna?
No, I think that covers it. Yeah.
Well, that's perfect. And yes, we, as you have all made abundantly clear here today with all these changes, it's tough for us to keep up and track all these things. So we certainly do need great folks like you. So I want to thank both of you very much for your presentation today. Incredibly informative. Really appreciate that. I think we are going to take a quick 10-minute break, and then we will be coming back with our next segment. So again, thank you to our presenters, and to all those at home, just stand by for about 10 minutes.
All right, thank you very much. Have a good day.
Next up, to tell us everything we need to know about property tax, we have Pullman and Comley's Property Tax and Valuation Chair, Attorney Greg Servodidio, and CCM's Advocacy Manager, Randy Collins. Greg and Randy, please take it away.
Thank you, Eric. Good morning. I guess I'll just start with a few opening remarks and then turn it over to Randy. As Eric mentioned, my name is Greg Servodidio. I'm with the law firm of Pullman and Comley in the Hartford office. I chair the firm's Property Tax and Valuation Department. Our department in general, and my practice in particular, focuses on commercial property tax appeals throughout the state of Connecticut and other portions of New England. We also do work in the area of eminent domain. What I hope to do in this morning's session is after Randy has an opportunity to update us on some important legislative developments that occurred this past session, I'd like to offer the taxpayer perspective on some of these initiatives, certainly get Randy and perhaps Eric's thoughts on the genesis of some of these proposals and some of the attitudes up on the Capitol about these issues. And then also talk to you about trends in property tax developments at the tax court here in Connecticut, what I'm seeing with regard to revaluations of property and things of that nature. But first, let me turn it over to Randy, who will take us through the important legislative developments that occurred earlier this year.
Greg, thank you. First off, I want to introduce myself. My name is Randy Collins, advocacy manager with the Connecticut Conference of Municipalities, and mostly now focusing on my main issues that I cover at the Capitol are the appropriations in the Finance Committee, and really kind of a never-ending learning process of everything property tax related. And it's a lot of information. You know, as I said, the CCM, I like to refer to us as we're the municipal version of CBIA, and we work very closely with CBIA. So, you know, they're a great partner and a great advocacy team that is up at the Capitol. That it's, again, when a lot of those costs that get rolled downhill to businesses, to towns, we very often collaborate to try to mitigate or stop some of those things. So right now, I just wanted to go through some of the to start off on some of the state kind of a review of the General Assembly. And I'll try not to read too much because I was never a big fan of PowerPoint. So I refer to it as death by PowerPoint. But so quick down and dirty, 2022 legislative session in review. We had multiple adjustments. It was the second year of biennium budget. We had, obviously, there were adjustments that were made to this budget, mainly coming through House Bill 5506, and then amended by Senate Bill 9 in the last few days. It was a little different this year. Usually there's an appropriations or spending bill, which will be followed by tax and bonding package, and then another larger implementer bill to kind of the nuts and bolts language. This year, they did the appropriation side, finance side, bonding side, and the implementer side in one large bill that came out on the Monday before the Wednesday adjournment session. It was about 700 plus pages, so there was a lot of information that we had to go through very quickly. So some of the key provisions of the adopted budget, it's a $24.2 billion budget for fiscal year 23, which was a 6.5% spending increase, and is $200 million under the state spending cap. It provides more than $600 million in tax relief. Most of that tax relief is going to be one time, will need to be reauthorized. It allocates almost the remainder of the American Rescue Plan, the ARPA allocations that the state had received. But I think one of the key things for municipalities, the state businesses, taxpayers, it positions the state to make an excess payment of approximately $3.5 billion into the unfunded pension liability. When you combine that with what has been previously made last year, it's almost 12% reduction in the state's unfunded in that pension liability. And I've seen numbers that will approximate savings at more than $340 million on an annual basis. So it's real money that they've been able to put in. Obviously, right now, our state rainy day fund is at its statutory maximum. I think the budget is coming in with almost a $4 billion surplus. So there have been a lot of talk of more substantive tax relief, more long-term tax relief. But there were some questions because of the federal money that we took, how much permanent taxes we could reduce while staying within the guidelines of the federal dollars that we received. They said some of the $600 million in tax relief that we saw, they extended the suspension of the state gas tax until December 1st. That did not suspend the diesel tax. So we're still seeing a lot of cost, especially businesses operating trucks. Temporary child care tax credit, $250 per child. Reduces the cap on non-commercial motor vehicles from 45 mils to 32.46 mils. And there's money to reimburse the towns for any revenue lost. Again, that revenue is only there for 1 year, so we're going to have to make sure that that money is allocated in future years. Otherwise, towns are going to have to shift that burden. It increases and expands personal property tax credit against state income tax. Increases the income tax, the federal earned income tax credit for the earned income tax credit. And then additionally deposits 40 million into the state's unemployment insurance trust fund, which is significantly in debt following COVID. And I think that there had been a strong push to see more money put into that. But unfortunately, we couldn't push that. We didn't see that go into effect. So some of the aspects, as I said, that budget bill was about 700 plus pages. One of the requirements that were put in there that if you look at property taxes, and especially as we're going through revals, property tax appraisal requirements for appeals. And basically what this would do, if the valuation of real property assessed at $1 million or more, it's going to require the applicants to file a property appraisal by a licensed Connecticut real estate appraisal company within 120 days of filing with the court. This is a CCM priority. It has been for a number of years, because every time what we're seeing over the last number of years is every time municipalities went through a mandatory revaluation, there'd be mass marketing from out-of-state firms, just blanket emails within a municipality offering no cost to the property owner, but they would file an appeal to reduce the assessment of that property. So in Hartford, this year when they revaled, they have 1,200 property tax appeals, which is tying up almost $950 million of their grants. And a lot of these, as I said, there isn't pause. In the past, it had created such a backlog within the court that the courts have pushed towns just to settle regardless of the merit of the appeal. Many municipalities just don't have the capacity or the money to fight 1,200 appeals that are going in just because of the legal cost. So what this simply does is, if you're going to file that appeal within court, then you have to have an appraisal done to show, the valuation, where that difference, a certified difference between what the assessor has posted as a value and what you think that is. Originally, it was a 90-day period to file that appeal. We worked with CBIA in the very last day of the session. They were asked if we could extend it to 120 days, which, again, because of our working relationship with CBIA, we were happy to accept as a late amendment to that. And Greg, at any point, if you want to jump in, certainly feel free to. One of the other aspects of 5506 that'll take effect in FY fiscal year 24-25, it's going to be changes to the way motor vehicles are assessed in municipalities. No one likes the car tax. It's onerous. It's not fair. It's difficult to collect. But because municipalities, the problem is municipalities, we are largely dependent on property tax as our source of revenue. We have inconsistent state aid. So every time that something gets passed down, the only way that we can fund that is through property tax or reductions in services. But one of the changes that we worked on and we accepted was a change to the process in which motor vehicles are assessed. It's going to exempt property taxes on snowmobiles, ATVs, and utility trailers for personal purposes. It's also going to require municipalities to value motor vehicles based on a suggested retail price, MSRP, with a set depreciation schedule, rather than schedule the values annually based on National Automotive Dealers Association. So it's going to be a cost saving to municipalities. It will also provide more consistency residents. And one of the big issues is because of supply shortages right now, we're seeing motor vehicle prices that are increased almost 20%. It's not going to help with this, but in the future, it should smooth that bump out and should smooth that out to provide a little bit more understanding for residents. Some of the other bigger aspects, especially for on the business side, it's going to move commercial motor vehicles. Your commercial motor vehicles will now be paid with your personal property declaration. The motor vehicle OPM is going to come up, Office of Policy Management is going to come up with new vehicle plate classes for commercial vehicles. So when you file as a business, my personal property declaration of this is my equipment, your motor vehicle will be listed on that same declaration. And it will also prohibit the DMV from issuing a motor vehicle registration to anyone who owes property taxes on a motor vehicle. So similar to if you own a personal motor vehicle, you owe back property taxes on your residence, you can't register that vehicle. That will now apply to commercial vehicles as well. Some of the additional legislation that we're going to have that we saw, House Bill 5168, an act concerning property tax exemptions, property used for charitable purposes. This is something that CBIA had, not CBIA, CCM has opposed for a number of years. As a rule, CCM, we oppose all property tax exemptions. Currently, there are now 100 mandated property tax exemptions that are on the books. Some of these do have pilot or payment in lieu of tax funding that's provided by the state, but that money is well below the statutory amount that was supposed to be in there because it's always done within available appropriations. And with that 100% property tax exemption, you have areas like Hartford, London, New Haven, some of our bigger cities, that almost 50% of their grand list is exempt from taxation. And every time we do that, it shifts that burden to our residents and our business taxpayers because they have to assume more and more of that cost. And as I said, municipalities often have very limited ability to reduce expenditures. Most municipalities have between 60 to 80% of their budget is in education. And with the minimum budget requirement, legislative law that's in effect, it is very hard to reduce expenditures on the education side. With one of the few exemptions, if you have declining enrollment, your student, you can reduce it by 10% per student. That's no longer within that. If you have declining enrollment, 10% reduction per student, that's not there. But as you can see, so every year the education costs continue to rise. So and there's that almost 1,000 unfunded mandates that the state puts on municipalities. So every time we have one of these, this is what we have to pay for. So as I said, so we opposed property tax exemptions for property used for charitable purposes, which eliminated a restriction on the type of housing that's used by nonprofit organizations within statute. Permanent housing, even if used by nonprofits, had never been permanent housing was never intended to be exempted from taxation. This now will allow, even if it's not temporary housing, a certain type of housing for vulnerable populations to be exempt. The language also requires municipal assessors to record reasons for denying property tax exemptions for certain nonprofit organizations. And it's also trying to requiring assessors to post on their website the form that organizations, most municipalities do that all. It authorized CCM members had looked for kind of a broader deferral of property tax evaluations. In the end, they passed 5167, which specified that the municipalities listed below can delay reval for 1 year. Typically, right now, I know OPM is working on moving everything towards a regional property tax, structure, reval structure. Municipalities required to do, reval every 5 years, a solid, and then I believe it's reval every 5 years, and then I can do a virtual FTP on the offside. But so there was limited deferral of property reval. 5169, this is a broad bill from OPM regarding their intergovernmental policy planning department planning recommendations. It made some changes to veteran tax exemption and veteran exemption portability. Again, you also in section 7, you can see where the regional revals requires municipalities to conduct revals pursuant to OPM designated regional reval schedule. And it's going to have those designated 5 revaluation zones using the state regional planning boundaries, which are roughly related to the existing councils of government COGs. It requires municipalities now must include a notice of assessment increase and provide information on the new and old gross valuation exemptions and net valuations. It also made some changes to add-on tax bills following a property transfer that extends a local tax collector's time frame for sending out add-on tax bills from 10 to 30 days. The bill applies to like tax bills that are sent out to transfer property that is subject to relief, property tax relief under the freeze tax relief program, the circuit breaker program, or any other provisions that made it exempt or eligible for abatement prior to transfer. So if there's a property that has, you're selling it with municipal machinery and equipment in it, that there's allows the assessor or the local tax collector additional time to understand what the changes are before sending that. I included Connecticut Clean Air Act. I know that CBIA worked very hard on aspects of this. This was a rather large, ambitious bill regarding improving the state's air quality. Made various statutory changes. Just highlighting a few regarding property taxes. Added new property tax exemptions to level 2 EV charging stations. Those are not fast charging stations, it's more traditional charging stations. So it exempted those EV charging stations that are located on commercial or industrial property, and on EV charging stations located on residential property. And it also exempted from property taxes zero-emission school buses. As I said, we opposed all property tax exemptions. School buses, we really didn't care because it's circular. If you put a property tax on a school bus for a private company, they're just going to increase the cost. It also will mandate municipalities require each new construction of commercial building and multi-use residential with 30 or more parking spaces to be equipped with EV infrastructure in at least 10% of those parking spaces. So if businesses are coming in and they're building a new, you're developing a new building, you have 30 parking spaces, you will be required to add at least 3, if it's 30 parking spaces, 3 EV charging stations within that new construction. It will be interesting to see how municipalities go about mandating that, because a lot of that will be having to do changes to local zoning and local building requirements. We've raised these concerns with the advocates, but and what happens if those changes are approved at a local level? They said they'd get back to us. And the bill also eliminates the reduced registration fee for electric vehicles and raising the triennial registration fee from $57 to $120, which is in line with traditional motor vehicles. So those are the quick updates that I have. And now I can pass it off to Greg and then we can move forward from there.
Thank you, Randy. And actually, if you don't mind, maybe we could go back to a few of your slides and you and I can have a dialogue about a couple of issues. And perhaps the first one we could talk about is the regional revaluation concept. So that would be 5169.
There we go.
Great. So as Randy mentioned, in Connecticut, we're on a 5-year revaluation cycle, and municipalities are required at least every 10 years to physically inspect property. And what's interesting about the 5-year schedule is currently it's not even. So in other words, we have years where we have a significant number of municipalities, including many of our larger ones, revaluing. And then we have maybe a couple of years within any 5-year period where our reval activity is lighter. And I gather that part of the thinking behind the regional reval is to try to smooth that out. Was that the case, Randy?
Yeah, so trying to, as I said, trying to smooth that out so that you don't see, a West Hartford doing their reval and then a Farmington delay. And so that way, for businesses, again, everything is moving on a more of a regional basis and not that 169, differential 169. So trying to bring everyone into concurrence. The other thought is that it will also allow municipalities to regionalize some of those services internally, share costs. And if you have more bordering municipalities doing it, there could be an economy of scale provided to municipalities.
Yeah, so there are only a limited number of revaluation companies that do this type of work. And we've heard for years a desire to try to bring down costs through regionalization efforts. So it seems like this is a major step in that direction. Another question I had for you, Randy, and Eric, you as well, if you want to join. As this was being discussed up at the Capitol, how do you envision this being implemented? In other words, we have communities, you mentioned Hartford, West Hartford, which just did a revaluation as of October 1, 2021. New Haven is another significant municipality that went last fall. Are you anticipating that some as we move from the current system to a regional system, are some communities going to have shorter cycles than 5 years, and some might have longer to get everybody in the region on the same schedule? How is it contemplated that that the transition will work?
I believe the transition is, I know that they're going to try to, I don't anticipate that they would do shorter. So I think you might have some municipalities might get an extra year if they move into that, to kind of catch them up to allow it to become, on a more regional basis. I think it'll be developed over a number of years. We're interested to see how this process plays out as well and how we get everybody on board, because then you always have, as we saw that bill that delayed reval and it listed out those specific municipalities. So every time we do that, it knocks that schedule off a little, and that's why they didn't do a broader municipalities made it for reval for statewide. So the legislature did in moving to try to keep people on track. They did it on a town by town basis. So I think I would anticipate that you would see more time rather than less time in a reval. But at the same point, as I said, I think we were coming out of COVID, we were very interested to see, and I think everyone's a little nervous of, residential taxes are going up, commercial property valuations are going down. How would that shift, impact municipalities? And I think there's some idea of, as I said, that's why we saw a more reval delays this year than we have in other years. And I think people are hoping that if we give it another year out, that some of those property tax valuations could stabilize a little bit. But I would anticipate that it's going to be more, you'd see towns get an extra year or so rather than being shortened. But I've been surprised on a number of times, over the years at the Capitol.
That's an important point to think about, because for those of you who either have been in the property tax appeal process or currently in it, or might find yourself in it in the future, most property tax appeals are resolved through a settlement, and that settlement is memorialized in a stipulation. And the standard template, the standard form for resolving a tax appeal is to agree to a value and to stipulate that the value will remain in effect for the balance of the revaluation cycle. And because we reval every 5 years here in Connecticut, intervening changes in market value are not to be taken into account. The value is set as of the base year, and then that value gets carried forward year after year until the next revaluation or until there are some physical changes to the property, new construction, for example. So as you're thinking about your property tax appeal and a possible resolution of it, I think you need to be cognizant of this bill and what Randy just said, and the notion that you might have to live with a value for more than 5 years rather than the 5-year cycle that we currently have. And that may change your calculus as to what kind of a value you as a taxpayer might be willing to accept in settlement of a case. If it's a value you only have to live with for 5 years, you might accept one number. But as Randy suggests, if the cycle gets extended by a year or two to accommodate this transition to regional revaluation, is that a number you want to live with for 6 or 7 years? And maybe the answer to that is no, the number needs to be somewhat different. So important point, bear it in mind. I think it's going to be very interesting to see how this works. Many states across the country revalue on a county basis as opposed to a municipal basis, which is the way we do it here in Connecticut, which is the way they do it in Massachusetts, for example. So it's going to be interesting to see if not only there are benefits achieved through more of a regional approach, but whether there is going to be a degree of consistency that we might not have seen in the past when a reval is being conducted across a region as opposed to a particular municipality. So there may be positives or negatives coming out of a possible consistent approach that might be born out of regional reval. Randy?
And that regional reval using, as I said, the regional planning boundaries, that typically those councils of government, we have 9 councils of government, very different sizes, but from capital region, which is 34 towns, to the metro, which is around Bridgeport, which is only about 9 towns. So those, I think the state we're looking at those is using those councils of government with regional planning aspects as almost county government light, but looking to, again, as you said, similar to what we see in more other states that have a county government structure where you can do, again, economy of scale, but also by doing a regional based approach, it should provide a little bit more, as you said, more consistency, because you can actually compare apples to apples when a Salem, Connecticut is going through reval, and you can look at the values based on what's also in Connecticut rather than, okay, I'm going to look at Salem and then compare it to a West Part. So it should provide a little bit more consistency within those geographic areas.
Yeah, it's been talked about for a long time. Another interesting aspect is the fact that just earlier this week, I spoke at the Connecticut Association of Assessing Officers annual tax school up at UConn. Every year, the state assessors gather for a week of continuing education. I spoke there on Tuesday, and in some of my sidebar conversations with assessors, I was hearing something that we're hearing not only in the assessing profession, but also in the appraising profession, and in perhaps in your business. And that is the challenge of getting the next generation of professionals into those spots. And like other professions, the assessors are aging, and it's becoming increasingly difficult to find young assessors to step into the head spots in municipalities. So this regionalization effort may help address that situation as well. That, I don't know if that was an intended benefit of this or not, but certainly would be an unintended potential benefit.
Yeah, oh, certainly. I mean, and I've worked with the assessors very closely for years, even prior to my time at CCM, and absolutely seeing, more and more municipalities having a harder time, finding, and you need to have a certified assessor to sign off annually on your brand list. So a lot of municipalities will have to, I think Bridgeport doesn't have its own assessor, so they pay the Stamford assessor comes in 1 day a week to work in their office. And obviously that costs a significant amount of money for somebody to come in for 1 day a week. And some of the other things that we've seen is, until recently, there was some protection for assessors, something that I worked on again prior to CCM, but that CCM had opposed, that gave municipal assessors a little bit more protection, job protection. That was removed in an implementer a few years back. So it served to protect assessors from political influence of, especially when you're seeing property taxes, residential values go up. I don't want that. I'm going into election year. I need you to, to put your thumb on the scale, so to speak. So, it's important that we allow those assessors to have that enough independence and autonomy that they can properly assess and fairly assess the properties across the board, and not, again, be influenced to, shift that burden from one payer to another. Unfortunately, the property tax burden is huge in Connecticut. It's detrimental to home ownership, to economic development, but until we can get kind of comprehensive tax reform through the legislature, which is going to take significant work and compromise by municipalities, businesses, cost containment from, and the ability for municipalities to save, we're going to have, all of these different issues where, reval and different tax exemptions become very difficult and onerous and hotly contested. So, that property tax burden is a significant problem, and we're going to, again, it's something that as a long-term goal, CCM's been looking at, and we'll look to engage our partners up at the Capitol and really, as I said, at some point we need to address that elephant in the room. It's so, a company comes in and, the day they buy that piece of property to build a business, they're on the hook before they produce widget one, and as we're seeing more of a global economy, more of a internet-based economy, they're not competing, the West Hartford competing against East Hartford is becoming more limited, but it's more, my West Hartford company competing against a North Carolina-based company. And we need to figure out a way to level that playing field and promote our economic development.
Great. Later on in the program, Randy, I'm going to ask you what comprehensive property tax reform might look like, but let's hold off on that, because whenever I hear that term, I'm always fascinated, because it always seems to me that every individual has their own view about what comprehensive property tax reform means. But if you don't mind, let's hold off on that a little bit later. Could you go back one slide to the revaluation delay legislation? So we were talking about the every 5-year revaluation schedule in Connecticut, and you see that the General Assembly passed a bill permitting the enumerated municipalities to delay a reval 1 year. In the case of Danbury, Orange, Wilton, and Stamford, they are slated to go October 1, 2022. They have the option of delaying a year. Now, until that option is exercised locally, I guess it's not a done deal, but now they have the legislative ability to do so. And the sense I get is that first of all, these delay bills have periodically popped up in the General Assembly. What is very interesting to me is the concept did not pop up in the depths of COVID. And you might have thought that we would have seen delay in the depths of COVID, the 2020 and the 2021 revals. That didn't happen. Instead, as we're coming out of COVID, a delay bill cropped up. And as Randy alluded to, I'll express a personal view that what this is really is an effort at market timing of revals. So over the last couple of years, we've had different sectors of real estate impacted differently by the pandemic. There are, and I'll focus primarily on commercial real estate, but I think we all know what's happening in the residential real estate sector, that's been a particularly hot sector. So let's talk about commercial real estate. What trends have I seen over the last few years in property values and in revals? A few sectors have been very hot. The one that comes to mind immediately is apartments have been very hot. And it seems like every week in the Hartford Business Journal, we're reading about another apartment project that's either completed, proposed, in construction, et cetera. That property sector, there's been a lot of activity, both transactions, new construction. Values have been stable, if not increasing, during the pandemic. So that sector has held up incredibly well through the pandemic. And in fact, as I studied the New Haven reval done as of October 1, 2021, where you have a lot of new apartments that have come into the marketplace, the growth in the grand list that was seen in New Haven, a large part of it attributable to increases in multifamily values. Same thing here in Hartford. Of all the sectors, I think multifamily in this reval has shown a lot of stability, if not growth. Another sector that has shown a lot of stability, if not growth, is industrial, warehouse, distribution, industrial properties. And again, in those same Hartford Business Journal editions, we see a lot of talk about Amazon putting up new facilities and other companies putting up new warehouse, distribution, industrial facilities. That sector has been hot during the pandemic, and that's been reflected in recent reval activity. What sectors have suffered? The ones that come to mind immediately are hospitality has suffered during the last few years. Multi-tenant office, obviously with the trends that have occurred in work from home, et cetera, those properties have suffered. So as I think Randy alluded to, whenever you do a revaluation, there are shifts in tax burden that occur based on what sectors are up and what sectors are down. And in this environment where you have certain commercial real estate sectors and single family properties that are up, and then certain sectors of commercial real estate that are down, what you're going to see is shifts in tax burden off of those classes of commercial property that are down and onto the hot commercial real estate classes and the single family. So I think what these communities, one consideration in delaying, and this has been in the press, so it's a little more than speculation, is the hope that particularly the single family will cool off a bit. Some of the other sectors that are down might come up, and therefore the property tax burden, which would otherwise shift more dramatically onto the homeowners, will not shift as much. So as owners of commercial real estate, you should understand that these delay opportunities, I think, to some extent are intended to try to time the market so that that shift is ameliorated to some extent and comes back onto the commercial real estate. So it's something, it's something to bear in mind if you're in these communities. And again, if you're involved in the property tax appeal process. One other class of property that I'll just mention, which is sort of hot, is renewable energy. And it probably beyond the scope of today's talk to get too far into the renewables, but obviously there's a big push for renewable energy, wind, solar. The latest thing that people are talking about is battery storage facilities. So as we bring on more renewable projects, where does that energy get stored? At this point, it can be stored in essence in the grid by going back into the grid. But there may come a point where the grid can't accommodate all the energy being generated by the renewables. And we'll need storage facilities to store the energy, since you can't time when solar or wind will produce electricity. You can't say produce it at this time when there's peak demand, or not at this time. So I think in an increasing number of communities, you'll see proposals coming forward for battery storage facilities. And there are a lot of questions about how you value those, how you, whether exemptions apply, and also whether property tax agreements can be put into place. I've worked on a few with renewable projects. But this is a whole new class of property that we're increasingly seeing in communities across the state. That's, I would say, hot at this point. Randy, anything you want to add to?
No, we had numerous conversations around that issue. This session, it just given the shortness, I mean, this year was by statute the way the schedule of session, the way that the session was scheduled, which is set in statute, was the shortest possible session that we could have had. So we had CCM was within talks with the solar community, the commercial solar community, about looking at the tax assessment of solar, and maybe moving away from a property tax base to a kind of a uniform rate based on the energy produced, which would provide a little bit more stability and understanding for those companies when they come in and want to develop, renewable energy solar facilities. Because right now, as it's we've seen some developments where 3 megawatt and under is exempt. And we have had cases where we've seen a 12 megawatt property, a property that develops 12 megawatts, but then they subdivided into 4 parcels, each under 3 megawatts to skirt, to get around that law. So this would basically eliminate property tax and set a uniform cap on based on the energy that is produced. There really just wasn't time between hybrid COVID session that we had, but it was something that we had discussed with Senator Norm Nadelman, who's also first selectman and chairs the Energy and Technology Committee and the advocates, and something that we'll continue to work on, because we understand that this is something that, is there a better way to do things, because that property tax application works for some areas, doesn't work for other areas, and how do we diversify where those installations are going in? And again, it provides some consistency, but at the same point, we do get a little nervous when we hear, uniform caps or a uniform fee, because again, our municipalities are very different. But it's definitely going to be an issue. One of the other things that we've worked on in terms of property tax, growing industry. Last year, we passed a law regarding hyperscale data centers and allowing municipalities the ability to waive the property taxes on these hyperscale data centers, and then sign an MOU with that entity for a set fee schedule in lieu of assessing property taxes on theoretically these $400 million build outs. And there are significant state tax exemptions. I don't know, there's a few that are in conversations, especially most of them are revolved around areas that have municipal, like, municipal utilities, because they can adjust the rates more easily than Eversource or UI. So again, but you can see where how property taxes, used to apply straight up property tax, traditional property tax bill to a $300 to $400 million data center, that it just wouldn't be cost feasible to bring these in. But the economic benefits of doing these and pulling in more of that tech center with high-speed data could be beneficial for on regional projects. So it's one of those that we're certainly looking at. How do we make our property taxes regressive, but can we make changes to encourage business development, reduce costs, et cetera. So but that the energy, that renewable energy is definitely a hot issue that we will see. Again, we'll have to wait in significant election year. I think it's 36 members of the House of Representatives at least that are not running for re-election. I think there's 6 out of 36 senators. So we're going to see some significant changes within the legislature next year, which will reshuffle the deck and hopefully provide some opportunity for new thought and new ideas.
It's very interesting about the renewable. I'll offer my perspective. I mean, I'm contacted regularly, including yesterday, by developers of different renewable projects, and what they want is a primer on what they could expect in property tax treatment of their facility. And I do the best I can laying out the basics, the fundamentals, but obviously there's a degree of unpredictability that comes into this because you're dealing with 169 municipalities, not quite that many assessors, but a significant number of different assessors, and different assessors look at things differently, as fundamentally as whether something is real estate or personal property. And the classification of the property has different property tax implications. For example, personal property is depreciated annually down to a floor, whereas real estate, as we've talked about, is valued once every 5 years, and the value remains static. So the threshold issue of classification has property tax implications. Then the issues of exemption, whether or not they apply, and the issues of valuation, because this is new. Assessors don't have experience in valuing renewable facilities. So when I'm asked to give the primer on, okay, Greg, I'm proposing to build this solar farm or this new battery storage facility, what can I expect? I can go so far to tell them what I think you can expect. And then there's that last piece of it where I just say, there's some variation in this. That's why entering into these agreements, which is the current, under current law, Connecticut General Statutes 32-71A is a statute that permits municipalities and developers of electric generating facilities, and that would include certain renewable facilities, to enter into agreements to fix the property tax expense or the assessment for a period of 20 plus years. And the major advantage of those agreements is the predictability that they afford, both to the municipality and to the developer. The municipality obviously wants to budget the new tax revenue a year after year, and doesn't necessarily want to see spikes in it that are not anticipated, up or down. And the developer, who likely has to go out for financing and is being asked by a lender, okay, what's your property tax expense? What are you projecting? Would have the benefit of predictability in that expense with the existence of an agreement. So the agreements really, in my view, and again, I've worked on a few of them, really work to the mutual benefit of municipality and developer. But they're discretionary with the municipality. And I've had clients in situations where the municipality, for whatever reason, political or otherwise, says, I won't enter into an agreement with you to establish the property tax amounts. And then you're in the property tax appeal process, and with the unpredictability that produces around classification, exemption, valuation, or some combination of those issues. So really, I'm a strong advocate for predictability. And if the General Assembly and CBIA and CCM can work on something that would add predictability, I think it would, and reasonableness, obviously, I think it would benefit the state and benefit the renewable energy industry and benefit the municipalities, so that they're not left trying to figure out, what is this thing worth?
I think one of the other issues we run into is technology develops so quickly. So the tax statutes relating to it become very convoluted. As technology develops, they'll add a section to an existing statute, but that has ramifications. It comes into conflict with something else that wasn't anticipated 5 years ago. So think about cell phone technology, data technology, and often it's very hard for statute to keep up with technology. And again, that over-reliance on the property tax creates a burden of how do we shift and how do we pivot to embrace new, and grab new technologies. I don't think we're going to have a state that does, both manufacturing, too many costs here, but high tech, I think we have an opportunity given the workforce and that we have. So, are we positioning ourselves to adequately grab those? And do our property taxes allow companies to make that investment? Because it's not just property tax, but energy costs, labor costs that all are factored in. So periodically we do need to go through and say, is it time for a comprehensive review of renewable energy statute? Does it all still make sense compared to, again, piecemeal changes over 5-10 years? So, is that process of going through a rate adjustment at FDPC, that a timely enough process to attract some of these businesses, which, they're looking at 3 states and, it's going to take us a while, and they'll have to say, what, fine. They'll go to Pennsylvania, they'll go to North or South Carolina. We need to make sure that we're positioning ourselves locally and statewide to compete for those companies.
Great. Randy, perhaps you could go back a few slides to the 5506 as it relates to property appraisal requirements.
Yeah.
Great. Sorry, we're going backwards, but sometimes in life you have to go backwards to go forwards. So this is a very interesting provision. And again, it was interesting to hear Randy's perspective on it. I'll offer my perspective on it, and then perhaps we can have a discussion about it. And what I'm hoping to do is also segue at this point into my discussion for your benefit about what's happening at the tax court, where whether it's state tax disputes or property tax disputes often end up. So there's been an effort at the General Assembly over a period of years to try to impose requirements that, again, this is me speaking, that would have the effect of diminishing the number of property tax appeals. And this, I think, is the first one to actually make it through the legislative process. It's come up year after year in different forms. What I thought was very interesting about this bill is the concept did emerge from committee in what I'll call sort of a standalone bill or a more focused property tax bill, and was the subject of public hearing. There was opposition filed by CBIA. I think the Connecticut Bar Association opposed aspects of this bill that actually didn't make it through. Then what happened in the end of the legislative session, and Randy maybe can comment on this, is the bill morphed from a standalone bill into being dropped into the budget bill. And of course, when it gets dropped into the budget bill, it becomes a lot harder to deal with because it's now buried in a 700-page budget document. So for those of us on the outside looking in, we thought that that's not a good bit of news because now this is in the budget bill. My personal view on this bill is it's unfair to the business community. It's unfair to taxpayers. It imposes obligations on taxpayers unilaterally that will be a challenge to meet. Keep in mind that in the reval process, we've been talking about revaluations. In the reval process, the municipalities are putting values on property on a mass appraisal basis. And I'll just make up a number and say that they're paying $1,000 a parcel to put a value on a piece of property. I don't know that that's the right number, but just I'll throw out that number. In my experience, the quality of revals varies dramatically from town to town. There are some companies that are good. There are some companies that are not very good. I always think it's a bad sign when you show up for what I call an informal hearing to discuss a proposed value, and you're talking to somebody from Massachusetts who barely knows where the town is that you're talking about and has no idea about the property you're talking about. And maybe they'll share with you some information about how they came up with the value. Amazingly, in some cases, they're reluctant to share the information so that you can understand how the value was derived. And then you're in the position of trying to deal with a value that in some cases is flawed. And what I've observed is there are 3 levels of appeal to challenge a property tax assessment that you think is unfair. The first level is what I was just describing, the informal hearing, where you're meeting typically with the revaluation company. That is always the best level of appeal to take advantage of if you can, because that value hasn't been set in stone yet. It's not on a grand list. There's some flexibility that the municipality has through the reval firm to make an adjustment. So if you do have that opportunity of an informal hearing, that's always a great, if nothing else, a great way to just get some information about how the value was established, if not to offer a counterpoint of view. Typically, revals are done as of October 1 in a given year. The preliminary values typically will come out November, December, and the notices that come out, which are sent to the address that the tax bills go to, will alert the recipient about the opportunity for an informal hearing, how it can be scheduled, etc. So those are often occurring in November, December, and January before the grand list is signed, typically at the end of January, with extension at the end of February. If relief is not obtained at that initial level, then you go to the Board of Assessment Appeals by February 20th. That's a statewide deadline that, again, can be extended a month if the reval is delayed a month. Unfortunately, our boards of assessment appeals in Connecticut don't really function all that well. Many boards either will deny appeals without hearings or view their role as supporting what the assessor has done rather than fulfilling their role as an independent body, hearing taxpayer concerns and acting on them when appropriate. So in my experience, having done this for 30 years, it's a distinct minority of times do you get the relief that you think you're entitled to at the board level. And then, increasingly we're seeing with the commercial properties, boards denying appeals without hearings and sending you right to court. So the opportunities to try to address issues informally or at the board level are not as robust in Connecticut as they should be or as they could be. So cases do find their way into court, probably more than they should for that reason. And now with this legislation, you have an obligation imposed on a taxpayer within a very short period of time after commencing the appeal. So again, you don't know if you're going to get relief at the informal level. You don't know what's going to happen at the board, but you have to file your Superior Court appeal within 2 months of the board decision. And now you're in court, and within a relatively short period of time, you now have to spend $10,000 to obtain an appraisal. Now, again, I'm not saying that that's the number. It could be 5,000, whatever, but a significant amount of money has to be expended. And there are many cases that I'm involved with where reductions can be supported by data that doesn't rise to the level of a full appraisal. I've been involved in a number of situations where there's been a purchase price that a reval firm or an assessor will not recognize. You go in and say, well, my property sold within a month or two of the valuation date for this, and they don't want to pay attention to it. There might be an appraisal done for another purpose that you share, and they don't pay attention to it. There could be a whole variety of ways that you can present data to an assessor, a reval company, to indicate there's an issue. And sometimes they react, sometimes they don't. The tax court typically has put these cases on a schedule. The tax court has been a believer in early intervention to try to get the parties together to see if a resolution can be reached. And by and large, in my experience at least, the tax court does a good job of putting cases on a schedule that would have the effect of weeding out any appeals that were thought to be frivolous. And I would also just suggest that a frivolous appeal is in the eyes of the beholder. I can't tell you the number of times I've been told by assessors that my appeal is frivolous, and then we obtain a reduction. As a matter of fact, I tried an appeal late last year involving the Danbury Fair Mall. The city indicated on numerous occasions that they thought my appeal was frivolous. We couldn't resolve it. I tried it to Judge Cordani over a number of days, and the judge ordered a $60 million reduction. So again, frivolous is in the eye of the beholder, I believe. So I personally view this as unfair to the business community. And I think it may actually work. It may have a counter impact, because if a company has to go out and spend money on an appraisal, chances are its position regarding a resolution may harden. as opposed to being more flexible, because they've now invested the time and money in an appraisal report. And it may have the effect of making some cases even harder to resolve. Those are my perspectives. Randy, I would welcome
Yeah, thank you. I mean,
your perspective.
this is something that we've looked at for, as you said, a number of years in various iterations. And we were able to push this one in, one of those issues we didn't agree with CBIA on. But again, when we would see the municipalities would see, an Ohio-based company just emailing all the businesses within a city saying, hey, no cost, we'll pay your taxes, and create such a backlog. And that we thought, it's just, we figured if something to the point where it is going to court, that the idea at that point of an appraisal is, something that would be required. I couldn't go to court and say, I think my taxes are wrong. And the assessor has the data that they do. And well, why do you think it's worth? I just think it's worth it. So I would need something to counter what the town is saying. So as we get into that court level, we thought that this was something that would weed out people like, hey, I'm going to sign up with this company because they said I can do it. It requires a small amount of skin in the game for companies. And in the end, because a lot of it, as I said, when you look at Hartford with 1,200 appeals, and even if some of those, and if some of those are accurate, those appeals are justified, and then they should, and if those appeals are justified, well, then they should see a reduction. It should be a fair value for the property that they have. But if you have so many that towns don't have the resources to go to court and they start to settle just to clear them off their book because they don't have the money to pay attorney fees for 1,200 cases. Every time that property value is reduced for a specific company, and especially if it's not justified, it's going to shift it to another payer, resident or business. So we felt that this is a better way to provide a fair market for everybody that's out there. Again, as long as we're overly reliant on property taxes, we need to make sure that we don't want to overtax our residents or our businesses, but at the same point, we don't want to give a pass to an entity and then somebody else is going to have to pick up that money. That doesn't reduce the local cost. So we thought that this was simply, setting a bar and saying, hey, we just want that certified appraisal. Show me the paper that, show me the evidence saying, yes, this is why I think my valuation is too high. Again, it's just one of those of everyone needs to, with 100 mandated property tax exemptions, we just want to make sure that everyone who does have to pay is paying their share and not picking up the burden from somebody else. And again, we're just seeing more and more of those mass market, tax appeal being even unsolicited, coming in every time a municipality does evaluation. We've had cases where, we've had assessors going to court, the judge literally told them, cut a deal. I'm telling you right now, cut a deal. And justified or not, that they were told. And we've had judges that were actually, censored for some of the conduct that they've had. So we thought that this was a kind of I know that there was the other aspect I think that was taken out, would have prohibited contingency fee arrangements. That was removed to put this in. And as I said, we moved it from 90 to 120 days to get that appraisal. But there's also still the judge can grant, the court can authorize the extension on that if you go in and say, hey, I've contracted with an appraisal company, they can't get there, but we're under contract to do it. So we don't want to take away people's rights or their ability to, appeal that property tax valuation that they've received. But again, it's really moving towards, I know you didn't like the word frivolous, but where people, hey, I'm just going to throw my name in the ring. It's no cost to me. And, if I get my burden reduced by 10%, company keeps 5, I keep 5. It's a win-win without any skin in the game at all for that person filing the appeal. Again, as long as we're just relying on the property tax system, it's what we need to, we need to make sure that we are collecting what municipalities are entitled to. And again, we don't want to collect extra. We don't want to collect less. It's just we want the fair market value for the properties that are within our municipalities.
Thank you. One other thing I'll just mention, and one of the grounds of opposition by the CBIA is the fact that, as I mentioned, with the assessors aging and young people not coming into the profession, we're seeing that to some extent with appraisers as well. So it's becoming increasingly challenging to get a commercial appraisal within a relatively short period of time. And where the property is more complicated, the issue is just magnified. So that was one of the grounds for opposition that CBIA voiced. And, you know, we'll have to just see how the court deals with it. Randy points out the opportunity for extension. I think the tax court, Judge Cordani, the presiding judge, recognizes that there is a long lead time for municipalities and taxpayers in getting appraisals. And he's, at least up to this point, been somewhat flexible in working with the parties in light of those industry constraints.
And I think if we see an undue burden that, you know, there's a hard, you know, significant number of cases where they couldn't get that 120 day, they couldn't make that work and they weren't getting relief, then we go back and we revisit the legislation. But I think we wanted a starting point. But again, it's not something that we're using to, you know, to hammer that business community or, you know, as I said, we really look at it as, you know, for businesses that aren't filing an appeal, you know, that it shouldn't be on them to have to eat the, you know, to absorb a burden either, because their property taxes are already enough of a burden. So, but if, you know, if this has unintended consequences, then we'll certainly, you know, go back and work with CBIA. And, you know, as I said, in all the testimony that I submit at the Capitol, you know, I would always talk about, you know, shifting burden to residential and commercial taxpayers. We are worried about our businesses. They're the lifeblood of our community. So it's, how do we strike that balance, you know, given the system we have?
So at this point, I think it's a good segue for me to talk about what's happening at the tax court. Then I'd like to get Randy's perspective on what he's seeing in his crystal ball regarding comprehensive property tax reform, what may be coming down the pike next year and in the coming years. So what's happening at the tax court? There have been a lot of changes. For those of you who've been through the property tax appeal process in years past, you may remember Judge George Levine as being one of the main judges at the tax court, along with Judge Arnold Aronson. Judge Levine retired a few years ago. Judge Levine had a particular approach. He conducted most of the pretrial settlement conferences at the tax court, if not all of them. And he had a particular approach, a unique approach to the pretrials. One of the things, his philosophy was he would pretry a case as many times as he thought was warranted to try to get the parties to some kind of a resolution. And it was not uncommon in a case like the mall case that I mentioned, a very complicated property type, where you might have an initial pretrial, the parties talk about initial issues and concerns. There's additional data that the municipality wants to evaluate the claim. Time needs to be allotted for the provision of that data, and then Judge Levine would have the parties back to advance the discussion. And you might have several pretrials on one particular case. He had a very high settlement rate, but as he said to me, part of his philosophy was there was not a lot of judicial resources available to actually conduct trials of cases. So he viewed himself as sort of a gatekeeper and put you through multiple pretrials to try to bring a case to resolution before he would send it on to trial. There's been a fundamental shift at the tax court with Judge Levine's departure, and we have a new presiding judge, John Cordani. Actually, Judge Cordani was the presiding judge 2 years ago, stepped away from the tax court for another assignment last year, but then came back for the current term, which begins in September to September, basically. So he's back as the presiding judge. And Judge Cordani is only willing to give the litigants one pretrial. In unusual circumstances, maybe more than one, but one pretrial settlement conference. He's much more willing to put cases on a schedule, moving them to a trial. And he's not shown any reticence about scheduling cases for trial. He does have a significant backlog of cases that he's dealing with. A big part of the reason there's a backlog is because of COVID, and the court shut down for a period of time beginning in March of 2020. So a lot of court events that were scheduled were canceled and had to be rescheduled. And then you had another set of revals that came online, adding more cases to the pipeline. So Judge Cordani is trying to deal with that backlog. There really are only two judges at the court. Judge Aronston is still there in a limited capacity. Judge Henry Cohn is there, and Judge Cordani. The main takeaway I think I want to give to the audience is that in light of this new approach, you should anticipate only getting one pretrial settlement conference in your property tax appeal, and perhaps even your state tax appeal. And what I am finding is where the case is right, where the circumstances are right, it would behoove you to reach out to the other side in advance of the pretrial and try to get a conversation going and try to deal with information exchange issues and try to set the stage for a successful pretrial settlement conference. Because if you only have one opportunity to have that settlement discussion, you want to maximize it, you want to make the most of it. And because you only have maybe 45 minutes to an hour, particularly with more complicated properties, it could be very tough just getting everything out on the table, much less having a conversation in that limited time. We're finding it more advantageous under certain circumstances to do that outreach to the municipality ahead of time to say, do you have what you need? Can we start talking? Do you have any questions? Do you want to come out and see the property? Things of that nature. Judge Cordani is conducting trials. He's very focused in the way he likes trials to occur. I have found in trying a couple of cases to him, and by the way, all the trials and pre-trials are still remote, and that presents its own interesting set of issues. But Judge Cordani is very focused on the valuation issues in the case, and he's not as much focused on what he views to be the ancillary issues. He's really an engineer by training. He has a scientific approach, I think, to property tax appeals. And he's very interested in getting right to the nub of the dispute. Is it cap rate? Is it market rent? Where are the points of convergence and divergence? And that's what he really wants the parties to speak to at trial, is those points of convergence and divergence, as opposed to more of the sideshow types of issues. He renders his decisions very quickly, amazingly quickly, within days of briefs being filed, not months. The judge has up to 4 months to render a decision. And he's not afraid where he believes there to be support for making significant reductions where he thinks that is warranted. So it's a new era at the court. I won't get into, it's really beyond the scope of this talk about the pros and cons of conducting events remotely at the court. But it's something that we've all had to get used to and figure out. And for the most part, it works pretty well. Although I think we miss some of that personal interaction. So with that, I'd like to turn it back over to Randy because he brought up the idea of comprehensive property tax reform. And I'm curious, Randy, as you look into your crystal ball, what do you see? What do people mean by that term? What do you think are going to be the hot topics of discussion in the property tax realm next session?
Well, I think it was 2017, CCM put out a report. And this report is different. In the end, it wasn't different. It went on a shelf like every other report that gets filed up to Capitol. But we looked at comprehensive property tax reform and the idea of basing it on really three areas. One was revenue diversification, becoming less reliant on just the property tax. And one of those was, looking at, an increase in statewide sales tax. But understanding that we didn't want this just to be a cash cap. We also included in the recommendations, language on cost containment. Where can municipalities, what changes can we make that will allow us to reduce existing costs? And the third portion of it was, increase opportunities for, the regionalization of services. Again, I think when we filed that report, the day that we went walk into the cafeteria at the LOB, everybody I talked to kind of came up and said, "Oh, the report was great. Loved two sections, hated one." Like the labor up there didn't like the cost containment language. I think, the CBIA, a lot of the CBIA members didn't like, the potential sales tax. So, but in the end, I mean, we have to look at a way, and there's no way that we're going to do property tax reform. Make significant changes that will position Connecticut and our municipalities into a better position to compete and grow our economy without everybody being willing to make certain sacrifices. I know, not this session, but last session, Sean Scanlon, who's, had taken over the House chair of the Finance Committee. Again, we'll have a new one next year. I hate having to educate new chairman. But one of the issues that he had brought up was the idea of the property tax cap. And, and we looked at that, and a lot of people look at Massachusetts and their property tax cap, but then you kind of educate them and say, well, when Massachusetts passed that property tax cap, they also put in significant protections for municipalities within it, because we can't have a property tax cap on municipalities if you don't limit the bills that you're sending to us. You can't send me a bill, but then tell me I can't raise taxes to pay for it. So in Massachusetts, with their property tax cap, they actually have a law on the books that you need a 2/3 vote of the Massachusetts General Assembly to pass an unfunded mandate on municipalities. So they have to vote 2/3 to vote to bring forward an unfunded mandate on municipalities, and then the membership then has to approve. So it's 2 votes to pass an unfunded mandate on municipalities. They actually have an office that reviews all the legislation to see if it's an unfunded mandate on town. And when I say an unfunded mandate, well, the state will pass along a requirement that we have to do, stormwater infrastructure upgrades, but then don't provide funding to meet that need. So it just becomes something that builds onto that tax burden. Massachusetts also absorbs significant levels of a significant amount of education costs, especially special education costs, which are huge drivers in local budgets. And they also passed arbitration reform, where municipalities can reject an arbitration award and not have to go to last best offer. So there were significant pieces that went through that provided Massachusetts the ability to impose that property tax cap, which has worked fairly well. As I said, I remember growing up, it was Massachusetts, and seems like the tables have switched now. So I think if we want that idea of property, there's a tax incident study, and I know they did it about 10 years ago, and unfortunately it's one of those, okay, we want a tax incident study, but any of the recommendations can't increase or decrease the tax burden. well, then you're just moving the deck chair. So at some point, we need to figure out a way of what is the better way of doing it. And everyone has to, they're at the local level, at the state level, the business community, everybody has to be, labor has to be involved in this and put in some, willing to put in some political capital, except some things that aren't necessarily something that you love to get a better product in the end. Otherwise, as I said, we go up there, some of the property tax cap at once, and we'll push back because you're not addressing the costs that we have or the bills that you pass down on us for. Hey, and so everyone has to sit in. And again, when we talk about local sales taxes and revenue diversification, the last thing I think we want to see even in CCM is, that being set at a local level. If there is a portion of that state sales tax, if we were to increase it, that it's done on a statewide basis and then distributed out. But we don't want to see, a West Hartford competing against a Farmington or East Windsor, South Windsor competing against East Hartford with lower sales tax rates. It should be applied uniformly. It also help with, businesses who have multiple locations, but everything with so much credit card transaction now that's being shipped, being sent online. So again, we look at the changes they made to motor. They didn't reduce the cost of motor vehicle taxes. The state just assumed $100 million portion of it. But what happens once the state doesn't have that $100 million? We're not in the big surplus numbers that we are now. That we either need to, the municipalities will either eat that $100 million and be forced to shift that to residential and commercial real property, or we have to increase the car tax, that mill rate from 2.6, and move it up to whatever the state can reimburse, which again is hard for residents, it's hard for businesses because it becomes unpredictable of where that money is. So I think because of our over-reliance on property tax, the inconsistency of state funding for those exempt properties, it just put us in a situation where that at leadership, as you said, at the local level, at the state level, at organizations, CCM, CBIA, need to sit down and say, how do we make this better for everybody? And willingness to go in and say, I'm going to give some to get some. As I said, it's going to be, I've been with CCM for 10 years. We've been talking about these issues for 10 years, and I know they've been talking about them for 20 years before. But until there's a willingness to say, we have to find a better system. Because again, it's not, our communities, town competing against town. We're now competing against states, we're competing against other countries in terms of, growing our economy. And how do we maximize our opportunities? The property tax is regressive, not just for economic development, home ownership. We have a lot of zoning issues and affordable housing fights over the last couple of years. But one of the big things is, we talked about building more houses. Are we bringing in the workers to fill those houses and to fill that? So it's something that that has to be looked at comprehensively in order to, move the system forward for everyone. I think, I would say let's start eliminating some of those existing property tax exceptions. I'm a believer in make the pie bigger and everyone can pay a little bit less, rather than how do I get more out of a smaller slice.
And I'll make two comments before we open it up for questions. With regard to the exemption issue, what I am observing is assessors are really scrutinizing exemption applications like never before. And we're seeing that exemption applications are being denied, where in the past they've been granted. In some cases, they've been granted for long periods of time, and then there's a reversal. So the whole issue of exemptions is kind of a hot button issue with assessors here. And you just, if you're in a position of applying for an exemption, I can't stress enough how as a threshold matter, you've just got to make sure that you cross all your T's and dot your I's in applying for it and documenting the entitlement for it. Whether or not an exemption should or should not be on the books, ultimately is a legislative determination, but as long as it's on the books It's available to qualifying property owners. And you just need to be certain that all your paperwork is in order, because part of what I'm seeing is if the paperwork is not in order, you're giving the assessor a reason to deny it that's not even related to eligibility, but to a paperwork glitch. And when I say pay attention to the paperwork, there can be some variation from municipality to municipality in what they're seeking to support an exemption application in a particular area. So you really need to focus in on what the particular municipality is looking for. And we covered it in Randy's slides, but there were a couple of legislative changes that I view to be positive in requiring assessors to provide more information to taxpayers about assessments, changes in assessments, denial of exemptions. Believe it or not, there was no standard practice around some of these issues, and it made our system more opaque as far as what assessors were doing and why. There were a few changes in Randy's slides that I think addressed that lack of transparency in a positive way. Section 9 there in Randy's slide is one of those examples. So I believe those to be positive. Just on the concept of comprehensive property tax reform, whenever people talk about property tax reform, I always find it interesting when they say our property tax system is broken. Personally, I don't think our property tax system is broken. And Randy, I think you and I are probably, if I heard you right, we're sort of saying the same thing. The property tax system, I think, is being asked to do too much. It's not that it's broken. This is my view. It's not that it's broken. As a matter of fact, I think the property tax system, I mean, it is a regressive tax. That's what property tax is. That's what property tax has been since the beginning of time. Our property tax system, I don't think is broken. I think it's fairly stable. It's fairly transparent, and with these legislative changes, even more so. There's predictability to it. There's a rhythm to it that people are aware of. So in my personal view, it's not broken. It's just we're asking too much of it. Spending has outstripped the ability of the property tax to fund local government. And I think that's what Randy's getting at by talking about diversification of municipal revenue sources and things of that nature. It's not that the property tax system is not functioning. It's just that we're asking it to do too much. And we're asking it to perform beyond the way it can perform equitably.
Yeah.
I don't put words in your mouth, Randy, but I think that's what I heard.
We even saw during COVID, I mean, yes, the property taxes are very stable. And, as opposed to the state's over-reliance, I think, on the income tax, which when the market does well, the state does well. If the market does bad, the state does well. But with that over-reliance on the property tax and I'll talk to legislators and they'll make changes to whatever program and they're like, oh, it's a state priority to do this. I'm like, that's fine that it's a state priority, but then why are you giving the bill to the municipality to do that program? Because again, the towns only have one option. Yet we're very restricted, we're very handcuffed on our educational spending, in terms of being able to reduce those expenditures. I mean, if a town through consolidation cuts down, we don't need an extra elementary school. We want to reduce that. To get relief on the simple property, the utility bills that use to, light that elementary school that we're no longer using because of declining enrollment, we have to go to the State Board of Education for permission to get relief from the MDL, just to not turn the lights on. So it becomes very frustrating of, where do municipalities save money? But when we talk about property tax reform, we also say, and if we had revenue diversification in whatever form that came in, but we also need to make sure that that revenue diversification is reflected in the property taxes and that it's just not a boom. One of the aspects that we looked at in that cost containment was if money had come in from revenue diversification, that would not be applied to the municipality's ability to pay in terms of labor negotiation. We didn't want that money to be spent before it's even deposited in the bank. We wanted to be able to apply that to start bringing down those mill rates, to start providing relief across the board for residential and commercial payers. So it's a just unbelievably complicated process of trying to move something as large as the property tax. And motor vehicles alone bring in over $1 billion a year to municipalities. At some point, I think we need to sit down and have those hard conversations of, and again, it's business, it's municipalities, it's labor, of how do we make the system work better? And again, you're right. I think the property tax is stable, but it's overburdened. And it becomes very hard, and it is regressive. I felt bad for a lot of businesses that we told restaurants or other businesses they had to shut down. Oh, sorry, COVID hit, close your doors. By the way, here's your property tax. It doesn't make it's not like an income tax where you're paying on what you earn, it's paying on the valuation of what you own, regardless of how much money. And that's also a detriment, as I said earlier, the companies coming in, the day they buy that, before they produce one widget or one piece of code, they're already in the red because they're paying property taxes on what they purchased. So, and then you get into, you want to do equipment upgrades to keep pace, property tax on that as well. So again, I think we're asking too much of that system. And at the same point, again, I argue against every single property tax exemption that goes up, regardless of the intent. And sometimes they're tough. I mean, I've argued against property tax exemptions for Gold Star parents. Not an easy one, but as a blanket policy, we oppose any further, reduction in those, as I said, in that property tax base. Otherwise, we have, like I said earlier, municipalities with 50% of that grand list exempt, and it just puts so much burden on the remaining taxpayers. It's not sustainable for growth.
Great. I know we're almost at the end of the program. I don't know, Eric, if you have any final questions or comments for us.
Yeah, I do have a quick question for you, but first, Attorney Servodidio, thank you so much for highlighting all of the practical concerns and challenges related to property tax. I mean, you are one of the absolute foremost experts in the state, and always appreciate getting your input on these issues. And Randy, likewise, you are an incredible ally on the vast majority of issues, always willing to go to the bat for the business community. Don't always agree on every single issue, but really do appreciate when we get to work together up at the Capitol. One real quick question for the two of you, because we are coming up on that hard stop. You spent a great deal of time in this segment talking about revaluation on a regional basis. And there was some other legislation in that same budget bill looking at urban transit districts and freezing their funding in order to encourage more real regionalization of services. In your minds, are we slowly moving our way back towards county government, or is this just efforts to create economies of scale? And if we are moving back, or we are just creating economies of scale, is that the right thing to do, or should we be doing the other? So why don't we start with you, Attorney Servodidio?
Eric, thanks. I mean, from my perspective, it's economies of scale. I think the regional reval idea is interesting. Frankly, we've been talking about quote unquote frivolous tax appeals, numerous tax appeals. One way to bring down the number of tax appeals is to reval more frequently. And if the regional reval bill has the effect of extending cycles, then I think that will promote more appeals, because people now have to live with a value for 6 years or 7 years. Many states, Massachusetts among them, reval more frequently, and that tends to bring down the number of appeals. So as we think about property tax reform, while the cost savings and the efficiencies of regional reval, I think, are interesting to contemplate. Maybe we should be moving in the other direction of shortening up cycles. I don't think we need county assessing like we see in other states. I don't think it's necessary.
I mean, right now, I mean, municipalities can do anything collaboratively under statute. They can do anything collectively that they can do individually. So you do see a lot of towns, especially smaller towns, have shared assessors, just because the level of work is more limited. I know I mentioned West Hartford. I live in West Hartford, but West Hartford's almost 63,000 people, with a vibrant business community. So a municipality like that, or Hartford, Stamford, they're going to have their own assessment. But I think there is ability to, regionalize some of those, especially the back office functions within municipalities. I think the COGS are, as I said, I refer to them as county government light, but I don't think in the end that anybody wants another layer of government, another tax bill coming to feed. But at some point, we look at, the PSATs, public safety entry. We have over 100 state of Connecticut. Southern California has 2. But, how do we, and there's been opposition to consolidating those both by labor and by some municipal officials that like having that person in the office, in the department at night. But so, I'll even say that there's points where, municipalities need a little bit of that stick to get moving forward, because the land of steady habits as Connecticut is it's so true. And that, again, we do a lot of changes like with car tax. We're doubling around the edges. We're not really addressing the issue of car taxes, but it's really valid to use revenue. So we need to be very careful, because if you eliminate that, great for a company like an Amazon with a big motor vehicle fleet, but for local retail, other businesses that don't have motor vehicles to offset that loss, it's just going to shift that burden on them. So, but please, no, I don't. I think we have the tools to do more regionalized services. It's just there's some changes that we also need. Local charters restrict the municipality's ability to do something. You're in charter, you shall have it in charter. I think we should be able to say, hey, in this case, we can share that HR director utilize technology. But I would, I don't know if I really want to go with that kind of system.
Appreciate that from both of you. All right, well, we're already a little bit over, but I just want to thank all of our speakers for educating us today, starting with PwC's Robert Ozmun and Anna Hoti for guiding us through the ever-changing tax landscape in the state of Connecticut, along with our last 2 presenters, attorney Greg Servodidio and CCM's Randy Collins, who helped guide us through some of the many property tax changes that occurred over the past few years. So also another thank you, of course, to PwC for making this event possible. And most importantly, I want to thank all of you who attended this virtual conference and continue to make it such a success each year. Thank you again, and have a great rest of your day. Take care, everyone.